welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I'm delighted today to have the return of Tom Hibbert from the Chief Investment Office.
Morning, everyone. Good to be back.
Morning. Nice to have you back. So as you know, the podcast is based on our weekly market review that we send out to subscribers on a Monday every week. The idea is that we try to be a little bit bite-sized. We try to demystify what's going on in a simple, easy to understand manner, so you hopefully can have a greater confidence in your financial future. So if you like what you're hearing, don't forget to hit follow on Spotify or Apple, or your podcast channel of choice, so you'll never miss an episode. So welcome to this week's Canaccord Coffee Break. Grab your coffee and listen in for about the next 10 minutes. So, Tom, it feels like it's been a quiet news week and that all everyone has been talking about is traitors. So this week we're going to go from reality TV betrayals to fiscal promises. And are we seeing similar plot twists in UK politics?
Yeah, absolutely. I mean, you say celebrity traitors. I've been so into it. It's been fantastic.
Amazing, wasn't it?
To see the final showdown between Alan Carr and Joe Marler. I never thought I'd see something like that, but fabulous.
Did you shout at the telly?
You know, I probably did. I can't remember. It was just a blur. But
we were screaming at the telly. I never go, no, Nick, how did you do that?
I know. Betrayal is rarely as dramatic as that, isn't it? But I heard that the game is based on a Russian psychologist who wanted to show that an informed minority can always outmaneuver an uninformed majority. It's quite interesting.
I wonder if they could say the same about the markets.
Yeah, well, we've gone for a bit of celebrity traitors theme this week, haven't we?
But, yeah, we have.
Yeah, and more for dramatic effect than anything. But.
Back to that. So is Rachel Reeves, Tom, a fiscal faithful, or is she betraying the electorate and her promises around further tax rises? That's the question this week. So what next for fiscal policy and why it matters for investors? So a couple of weeks ago, we talked about the Laffer curve. So I think it's probably pertinent to get into that in a little bit more detail this week.
Sure. So Arthur Laffer, he's an American economist. I mentioned it a few weeks ago, so we can expand on it with the budget coming up. So the idea is very simple. It effectively states that there's an optimal tax rate.
Yeah.
And if you raise taxes beyond that point, you don't get increased revenue. So eventually you end up with an inverse relationship between tax rates and the revenue that you generate, because when you raise taxes beyond that point, you end up depressing growth, disincentivizing work, lower confidence, you depress business activity. So you end up with lower growth.
So it acts as a total disincentive.
Yeah, exactly. And it's just bad for everyone, really. Yeah. So Rachel Reeves originally positioned herself at the beginning of this government around kickstarting growth. That was the sort of tagline.
How's that going for her then?
Well, exactly. You know, creating this pro-investment environment. She explicitly ruled out income tax rises and other tax rises. And we now have the highest tax burden since the 1940s. And the direction of travel is for that to only rise further, particularly after the recent sort of noises that have been coming out of the government. So it's now starting to feel a little bit more like revenue extraction rather than any sort of growth strategy. So I'm pretty confident, just going back to the Laffer curve, that the UK is already on the wrong side of the Laffer curve. Arthur Laffer himself, he's said that the UK is a textbook case of taxing the productivity base to the point of harm. He says that the UK is taxing itself to death. So I'm pretty confident that the UK doesn't need higher taxes at this point. It needs more output, higher output. So tax hikes without a credible pro-growth plan is just going to risk embedding stagnation. And I think we're now getting to that sort of point.
What happens if the government's actions risk trashing the economy? I think you mentioned that in the weekly markets review this week. And why might Rachel Reeves risk doing that?
Yeah, and trashing the economy is I was quoting Mark Dowding, who's the Chief Investment Officer of BlueBay, who we'll come on to in a moment. But there does seem to be this obsession with short-term fiscal headroom in Westminster.
So what does that mean?
So at the start, the Labour government has this idea, the first point in their economic strategy is to drive economic stability through tough spending rules. And those fiscal rules, in their own words, are non-negotiable. And it's kind of focused on short-term fiscal headroom that they've sort of defined themselves.
So headroom being the amount they receive in from taxes versus the amount they're spending.
Pretty much. I mean, how much they can effectively spend. Those fiscal rules have now sort of become the tail that's wagging the dog. And there is this growing voice that it's now dominating their policy in a way that they might now tolerate short-term economic weakness or trash the economy effectively to achieve more fiscal headroom. And how that would work is a significant slowdown in the UK economy. Would extinguish the inflationary pressures. Lower inflation would then bring interest rates down. The Bank of England could cut rates. You'd get lower bond yields. That would reduce government borrowing costs. And then you would have the additional fiscal headroom that Westminster is so obsessed with. Right. So yes, in theory, Labour could tolerate some economic weakness to ease the pressure on the gilt markets and to rebuild that fiscal headroom. But the cost is very real for the economy, and it's kind of putting the burden on businesses and employees, workers. So you end up with slower wage growth, weaker employment conditions, maybe higher unemployment, lower business investment, lower output, lower growth. And, that we could end up with a situation where that short-term weakness is sort of played off as necessary pain.
Without getting political, what's the alternative view to that? What might governments do to try and support growth rather than sort of this obsession with the fiscal headroom in the short term?
Sure, and we are now seeing some growing voices arguing that the focus needs to shift away from that fiscal arithmetic towards rebuilding the productive base of the economy, stop obsessing over the deficit on a short-term view, and start thinking about how to grow the economy over a medium term, sort of 5 to 10 years. So there's a think tank, the Centre for a Better Britain, which is being advised by some very experienced market practitioners. I mentioned Mark Dowding. He's one of those people, Chief Investment Officer at Blue Bay. He started to lay out the foundations for how that could work in practice. And it's about balancing fiscal prudence with prioritizing growth, deregulation. So you reduce the size of the state where it's grown inefficiently, particularly the civil service. You tighten welfare eligibility so that support is really targeted to those who need it the most. So maybe you needs test pensions, for example. You prioritize a deregulatory agenda, make it easier to expand businesses, a better environment for businesses to grow. And some of this thinking is now feeding into political strategy on the right side of politics. So Nigel Farage last week, in a speech, he toned down some of his earlier commitments to reduce taxes, to cut taxes, saying that there isn't the fiscal ability to do that at the moment. But he's then emphasized the need to grow the economy first, improve that efficiency and productivity base, and incentivize investment and business environment.
Which I guess from our perspective and from clients who are investing, that's what we'd be looking for. So, where does this leave the outlook for the growth and for the markets and ultimately our clients' portfolios, I guess? Yeah,
so there's an important data point tomorrow, which is the UK GDP release. Growth is expected to slow mildly. But there's a view that the combination of higher taxes, lower productivity, and sort of fragile confidence is acting as a bit of a brake on
nobody seems to be doing anything until the budget comes.
So you can see that caution already coming through you can sort of sense it, but you can see it coming through in some of the data as well, some of the soft data. So that's obviously important for the outlook for investment markets, for the economy, for everybody who lives here. But you can also be a little bit too negative. It's worth remembering that UK domestic sort of mid and small cap equities are up 18% for the year. There's been some pressure in the gilt market as bond vigilantes have been sort of...
Oh, bond vigilantes,
have been putting pressure on the UK government bonds market. But we have seen a lot of that pressure release in the last few weeks. We've seen quite a sharp fall in bond yields, which is a good thing. Largely, that's been driven by global factors and a bit of a softening, or at least a more accommodative stance from the Bank of England, slower than expected inflation. So there are some positive things happening in the background, but I think we just need to have a shift in policy now that balances fiscal prudence with growth. And I'm not hugely optimistic at the moment, but at least there are those conversations happening in the background.
So at least, as you say, if people are talking about this sort of thing, hopefully that might influence where things go in the future.
I hope so.
So let me sum up what's in my Canaccord takeaway coffee cup today. So we discussed what's next for fiscal policy and why that matters for investors, and that Rachel Reeves is still signalling further substantial tax rises despite her previous reassurances. And, is she the Nick Mohammed of the political world?
Or the Alan Carr.
And we talked about potentially that the UK is on the wrong side of the Laffer curve and that this risks depressing investments and long-term growth. But the conversations are happening. Let's be optimistic. Let's channel our inner Alan Carr and see what happens over the next couple of weeks. So thank you all for listening. I hope you enjoyed the Canaccord Coffee Break podcast. Don't forget to hit follow so you never miss an episode. And if you've got any thoughts, please share them with us at coffeebreak@canaccord.com.
Thank you for listening, everyone.
Thank you very much.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.